The question of whether the T-bond return is independent of the state of the economy can be confusing, but in fact, the T-bill return is not dependent on the state of the economy because regardless of the economy, the Treasury bill will need to be redeemed. The factors to look for when one is deciding which investment is best to invest in, a wise investor will look at the expected return table. Based on this, the investor will compare two different investments and make the best decision. In this case, the S&P 500 is more profitable, and an investor would likely go for that stock. Standard deviation and coefficient of variation. They both have to do with the volatility of the stock and being able to evaluate it by using these two statistical figures. In finance, standard deviation is figured as a dispersion set of data from its mean. The more spread apart the data, the higher the deviation. And it is usually figured out by taking the square root of the variance. The coefficient of variation is also tied directly to the standard deviation. It is the representation of the ratio of the standard deviation divided by the mean. And this is a statistical measure of the dispersion of the data points in a data series around the mean. A portfolio consisting of 50% TECO and 50% S&P 500 would not have the same risk reduction effects as a portfolio that was 50% Gold Hill and 50% TECO. This is the case because both the TECO and the S&P 500 are aggressive, high variance stocks. They do very well in a boom and very bad in a recession. So, in essence, if you had a portfolio consisting of two very similar stocks, you are losing the capabilities to reduce risk by diversification when you add two stocks that reflect and are correlated as far as their movements and their volatility with the markets going up or the markets going down. So you are not taking advantage when you do 50% TECO, 50% S&P 500, and you are taking advantage when you get two different stocks like Gold Hill and TECO that help each other by diversifying and opposing the movements in regards to either a boom or a recession. There's always the question of whether the more stocks that are added to a portfolio randomly will have an effect on the risk of that particular portfolio. There is an effect on the risk. With the more randomly selected stocks, diversification would go up and the risk of the portfolio as a whole would go down. For an investor, this would mean that the portfolio again was more diversified and therefore more safe. The funny lines we see on the graph are called regression lines. These regression lines on the scatter plot are made up of points which show different annual expected returns of these stocks. The distance between the plot points on the regression line, these are points that connect and reflect the line depicted with the smallest possible set of distance between itself and each data point. A lot can be deduced by plotting the security market line. If the expected return is greater than the required return estimated with CAPM, the expected return will plot above the security market line. There are two factors that have an effect on CAPM, inflation movements as well as market risk premium movements. Both have a direct effect on the CAPM. For instance, in our example, if inflation rose by 3% or 3 percentage points, TECO's CAPM would increase to 0.131. If the market risk premium rose from 7 to 8% to 1 percentage point, TECO's CAPM would still be above the original calculations of 0.128. And lastly, beta and its movements also do have an effect on the CAPM. For instance, again, using TECO's beta, if it rose from 0.6 to 1.0, TECO's CAPM would increase to being 0.15. If TECO's long-term debt decreased, what would happen is that their risk of default would decrease. With the less debt one has as a firm, the least likely it is that the firm will default and go bankrupt. So naturally the risk would go down, and the TECO stock would be more attractive for investors looking for lower risk stocks.